Hi, I'm Shiloh Bates, and welcome to the CLO Investor Podcast. CLO stands for Collateralized Loan Obligations, which are securities backed by pools of leveraged loans. In this podcast, we discuss current news in the CLO industry, and I interview key market players. Today, I'm speaking with Brian Nolan, head of European CLO Structuring at PGIM. This spring, I saw Brian present at the Credit Flux conference in London and thought he'd be a good guest to have on to discuss European CLOs and how they're different from US CLOs. At FlatRock, we invest in US CLOs, so this podcast was a learning experience for me. If you're enjoying the podcast, please remember to share, like, and follow. And now, my conversation with Brian Nolan. Brian, thanks for coming on the podcast.
Thanks so much for having me. It's a pleasure.
So why don't we start off with your origin story and how you ended up in the European CLO market?
So I went to school in Ireland, where I'm from, and I moved to London in 2010. So my first 3 years is not worth speaking about because it wasn't CLO related, but that was in Bank of Ireland. And then I moved to Fitch Ratings. So my background before I joined PGIM is in rating agencies. I spent 2.5 years at Fitch in the CLO team, 2.5 years in S&P in the CLO team. And now I've been at PGIM for about 7 years in the structuring team here.
And what's one thing that you find interesting about CLOs?
So I think my original 3 years, I was in corporate banking type role. And I think what some people might find interesting, but what frustrated me was the difficulty in finding information. So you spend so much of your time on various websites trying to get reports. The thing that I loved about CLOs, and this is probably a boring answer, is you have such a complete set of data that you can interpret and use. And whether that's in the rating agencies when you're trying to stress a portfolio or when you're structuring a portfolio on the issuer side, I just get a lot of comfort from having a lot of certainty in the numbers that we're using.
Okay. So at PGIM, is your role more structuring CLOs, or are you also playing a role in picking the loans that go into these vehicles?
Predominantly, it's on the structuring side. So we're one of the biggest CLO managers, both in Europe and the US. And with that comes quite frequent access to the market. So whether it's resets, refis, or new issues. So my team is responsible for structuring the cadence of those deals and when they're going to market and being as efficient as possible in terms of getting in and out of the market. Then when the transaction starts, we're responsible for making sure the bank is doing a good structuring job, and then a lot of the back and forth with investors on the CLO documents. So we have full-time analysts that do that. I think the thinking being that because of the volume, expecting the portfolio managers to do that on top of their day job is probably stretching them too thin. So it's very much making sure the structures make sense for the platform and then keeping the machine consistently going.
Okay. So are you working on structuring deals in the US and Europe, or just Europe?
No, I personally work just in Europe. So we have an equivalent team in the US that would do it for our US deals. And we're in constant communication to understand the differences between the markets. And usually it's the way that the US innovates in something first, and then they're explaining it to me so that we can try and do it in Europe as well. But occasionally maybe it goes the other way.
As a CLO manager, how does PGIM differentiate itself?
I'm sure most people have interesting answers to this. I think certainly the first one is quite a difference between Europe and the US. So in Europe, PGIM manages loans and bonds from the same team out of our portfolio management team. So if you look at our CLOs versus some of our competitors here in Europe, you will see a much larger proportion of fixed rate bonds in our deals versus others. So I think that's probably the most obvious difference between us and others in Europe. In the US, that's less so. I think up until a few years ago, Volcker restricted any bonds at all going into the CLOs. And I think even now, most managers just have a small 5% bucket. So it's less of a thing in the US, but in Europe, that's a big distinguishing factor. I would say generally, and this applies to both sides, is we've got a very active management style. So we would have a high churn rate. We have deep resources. So I think across the US and Europe, we've got 35 credit analysts and 15 people on the desk between portfolio management and traders. So that is to allow us to analyze things quickly, take a view quickly, and churn the portfolio, mostly through primary. So replacing assets that are less good relative value with primary assets that come in. So I think that is something we would say over and above what most people do is in our DNA.
So how big is the European CLO market?
I don't have the number in front of me, but I think it's about a quarter to a third of the size of the US market. So it's materially smaller. I think it's really since 2013 when 2.0s started going. I can tell you a busy year for us in Europe is maybe 9 or 10 deals in a year, where our US colleagues are in the 20s and 30s number.
So that'd be about 300 billion or so euros, I guess.
Yes.
And then in Europe, are CLO securities only denominated in euros, or are there other currencies that you guys are dealing with?
The vast majority is in euros. Within the CLOs, or you mean the liability structure?
I'll take both.
So within the CLOs, we have a construct here in Europe called a perfect asset swap, which is a derivative that you sign with one or two banks that offer it here, where it basically hedges your FX and is also linked to the underlying asset, such that if the asset prepays you or if it defaults, the swap is linked to that so you don't end up with a big mark-to-market payment that you need to make.
Interesting.
It's quite bespoke, which makes it quite expensive. So for instance, you could have a sterling asset that pays you 500 over, and the cost of the swap might be 100 or 150 basis points of that. So the actual real term, what you're comparing it to on the euro side, it has to be something compelling for it to make sense for the costs that's involved. So I would say in Europe, I suspect if you looked originally back in 2013-14, when the loan market was much smaller, you probably did have some of this happening as people were stretching to get diversity. As the European market has matured, I think you have a lot more options in euro loans now that it would be a small minority of managers that still use that flexibility. On the liability side, it's interesting because the vast majority of CLOs are issued in euro. We actually issued the only GBP sterling CLO. So that was back probably about 7 or 8 years ago now. That was just before Brexit. It was a very distinctive trade, and that was called a couple of years ago, so it doesn't exist anymore. That's the only non-euro deal that I'm aware of. Up until I think there was a mid-market CLO that was done quite recently, which was GBP sterling as well. So 99% of it will be in euros.
How many CLO managers do you have in Europe?
So this is an ever-increasing number as a lot of US platforms are moving over to Europe. I think if you look at people that have actively issued a deal in the last year or two, you're probably talking about 50 to 60 managers. If you actually look at every manager that has a deal outstanding, it's probably more like 70, 80. But a large chunk of those have not been active for a long time. And I think that's grown significantly. You probably add high single digits of managers over the last 4 or 5 years in terms of new entrants to the market.
Geographically, are most of the managers in London or spread around Europe?
The vast majority will be in London. You have 3 or 4 in Dublin, in Ireland. I'm aware of a couple in Scandinavia and maybe one in Spain, and then a few in France maybe, but I would say probably 80% plus based in London.
So then talking about getting into the assets in the European CLOs and how they're different from the US, the loans that go into CLOs often are created in leverage buyouts. Is Europe as friendly to private equity activity as we are here in the US?
I think that depends on whether you're looking at creation or other things that happen along the line. So I think one thing Europe has can be seen as a positive or a negative. You have a lot of regional diversity. So you have different domiciles with different regulations and different laws. So I don't think anything could be as friendly as the US because obviously it's very uniform there and very business friendly. That leads to potentially less efficiency on the LBO side. What it does potentially benefit you on the other side of things is if things go wrong, what you can see is the different regulatory regimes in Europe that are maybe not as sponsor friendly as the US would be do mean that you see things like less LME activity. You see a bit more of a relationship-based interaction between sponsor and CLO managers versus a transactional one, which maybe you might see more in the US. That's very much looking for the positives. I mean, up until the last few years when LMEs started to come through in the US, I think in Europe, there was a lot of frustration with how long things took and the various hoops you had to jump through in various jurisdictions.
So in a European CLO, is it easy to come up with enough underlying loans so that you have the diversity that the CLO requires?
Ultimately, I think that is becoming more difficult as the years go by and more managers come to the market. So LBO activity in Europe since the interest rate spikes in 22 has really slowed down, whereas issuance on the CLO side has not really. So you're definitely seeing significant demand for loans where the supply is not necessarily coming through on LBOs. So I think you definitely can struggle to do it in a fast way. And I think a good example of this is maybe print and sprint transactions. So I think these happen quite frequently in the US. And I know obviously the most our platform versus our US colleagues and how easy it can be for them to do a print and sprint transaction. Whereas in Europe, while there have been some done, and we did one, our original deal in the 2.0 era was a print and sprint, it definitely is more difficult to get that many assets very quickly.
So the print and sprint, in case people don't know, is just a CLO is forming without really any assets in a warehouse or a very small warehouse, if there is one. And the CLOs come into life and all the assets are just being bought in the secondary market.
Yeah, in a very short period of time. Whereas I think the typical warehousing period here in Europe is you generally ramp up those assets over a 3 to 6 month period before you issue the CLO. And to your point around diversity, I guess this is one key difference between the markets. So defining what's an acceptable level of diversity is quite different between the European and the US markets. So I think your typical US transaction is going to have somewhere between 250 to 350 individual obligors, whereas a European deal is probably half of that. And I think that's a function of the smaller market. And I would say that diversity amount has increased in Europe over time. If you go back to when the market opened in 2013, it would not be uncommon to see less than 100 obligors in a portfolio. Whereas now it's probably around the 150 number.
Does that tie to your earlier comment about putting bonds in your portfolios, that it's easier to get the diversity you need if you're also looking at senior secured bonds?
That was absolutely one of the key drivers when we originally issued our first European CLO 2.0. So I think as the loan market has matured, it's become less necessary, but we still think that your top 10 bond ideas are going to be better than your worst 10 loan ideas. So even though it might not change the number of obligors, it should give you access to a better quality of obligor.
So the base rate in your market is Euribor. Am I pronouncing it correctly?
Correct.
So the loans are floating on Euribor, and are they paying, is it 300 over like in the US?
No. So typically, if you look back in the long-term averages, I would say the European market generally is at a premium to on a spread basis. So a portfolio today is probably somewhere between 340 and 380, depending on the style of the manager. Whereas I think in the US, as you said, it's closer to 300.
And so what accounts for that premium over the US? Does that reflect liquidity or potentially higher loan losses that you need to be compensated for?
I think primarily it's driven by CLOs. So in Europe, the CLO buyer is in excess of 80% of the loan market. So we wouldn't have the alternatives to CLOs that the US would have. And on the other side of the equation, CLO liabilities generally price at a premium to the US. So in order for the arbitrage to work, the CLOs are floored at a certain level. And because they make up so much of the market, that technical can sometimes put a floor on where spreads can go until liabilities come in tighter. Equally, you could argue the loan market is definitely less liquid in Europe. We would still consider it a liquid market, but it wouldn't be the same as the US. So you could also imply that there is some illiquidity premium there versus the European equivalents.
So then SOFR, the secured overnight financing rate, is the base rate for US CLO. So that's at roughly 4.25. Where's Euribor? I know that's been coming down. Where does that sit today?
Probably date myself here. I haven't checked it recently. It's somewhere in the 2.5% area, I think.
2.5. So the ECB has been cutting.
Yeah, I don't think we went as high as you guys, but then we've been cutting as well.
So then the underlying loans geographically, is it mostly the UK, Germany, France, and maybe Spain, or what's the country mix there?
I mean, the ones you've named are generally the top. I would say the largest countries would probably be still below 20%, so it would have a regional diversity there. The UK, France, and Germany would be the largest. Then you would have Spanish, Italian, Scandinavians, as well as some more peripheral countries. So that is one thing. I think a US CLO will have more obligor diversity, but a European CLO will have that regional diversity where you do have some diversity benefits from having exposure to multiple geographies.
So in the US, I think that investors in CLO equity, for example, are assuming a loan loss reserve, which is a 2% default rate and a 70-cent recovery rate. In prior podcasts, I've talked about that being maybe a little bit antiquated or a little bit too beneficial for the CLO equity investor. How do those compare to what's happened in Europe and what investors should expect maybe going forward?
So yeah, I think the one thing we always say in relation to this is that a CLO is an actively managed portfolio. So when we look back across all of our portfolios over the last 10 years, we've done this analysis, and the vast majority of our deals actually have a positive annual trading. So when you take away the losses versus the positives, depending on certain vintages, for instance, if you go out of reinvestment period just before there's a downturn and you lose the flexibility, those vintages can be the most difficult. But I would say the headline numbers in Europe, the default rate has been materially below that over the course of the 10-year average. Obviously, that will differ year to year. And the recovery rate is, again, this is very idiosyncratic because you're going to have one that's 20 and another one that's 100. I think the average is in the 60 to 70 range across those defaults that have happened. So I think the recovery rate is one. Obviously, as the market has gone cov light, there was a lot of discussion around whether recoveries were going to be later or worse than long-term averages. I don't think there's been enough defaults in Europe really to get a meaningful amount of data on that. But what we have seen so far is obviously on a case by case, it can be wildly different. But if you look at the average across a bigger data set, we don't see a huge difference in the long-term average.
So are the assets leveraged on assets 4.5 to 5.5 times EBITDA with interest coverage around 3 times?
That depends on whose numbers you use. If you use the company numbers, that probably sounds about right. I think it differs per industry, but I think certainly on our numbers, we obviously do our own internal forecasts and look at add backs and what ones are realistic in terms of one-offs. We would see it probably slightly ahead of that. I don't work on the portfolio management side of the team, so I wouldn't be as close to that data as those guys would. I think your numbers sound like company projections in line with what we're typically seeing.
Is the reinvestment period in Europe, is it typically 5 years like the US?
I would say the average is probably 4.5. And I would say 5 years ago, it was probably 4 years. So it's slowly migrating. And we have seen deals that have done it 5 as well. But my understanding of the US market is it's much more standard to be 5 in most deals.
And so what's a good AAA spread over Euribor if you're issuing a deal today?
So today, I think the European market is potentially starting to distinguish between new issue and reset, and also between managers. So I know you've seen tiering in the US market for a long time, and I think it's probably a sign of the European market maturing more that we're starting to see that. I would say for a new issue deal today, you're probably looking at 130 or low 130s. For a reset, you're probably looking at mid 130s. And then, yeah, you could see certain deals in the high 130s, depending on if it's a reset, the quality of the portfolio and the manager and things like that.
So the spread for European AAAs is pretty comparable to what you find in the US then?
Today, I think so, yes. I think that has diverged over time, but as of today, it's actually remarkably close.
So then for the equity tranche, is that much more profitable in Europe, given the numbers you went through? I mean, if the AAA financing cost is the same as the US, but the spread is 50 to 80 bips more on the assets, that should be pretty lucrative for the equity tranche.
Yes. So I think down the structure, you probably are a little bit wider in Europe. So when you're looking at the weighted average cost, you should be wider in Europe than you would be in the US. But we've done some analysis looking back since 2018. We've done the high-level arbitrage calculation, which is the spread on the assets minus the cost of debt times the leverage. We would typically see Europe being somewhere between, and this is proportional, not 8 points higher, but about 8%. So if it's 15% in US, the equivalent would be about 16 or 17 in Europe. So I think it's generally looked a little bit higher. The other thing in Europe is we issue a single B tranche in almost every transaction, whereas I think that's quite rare in the US.
It is, yeah.
Which means you get more leverage, but obviously it's more expensive leverage. But overall, in Europe, it's accretive to the returns.
So at FlyRock, we also invest in double Bs. What's the spread over Euribor for double B these days?
So the spread, I think it's probably in the low 600s right now. I think that can be a bit volatile per manager. And I think it's demand and supply and technicals can have a big impact on that market. If you have a lot of deals all come at the same time, that can suddenly blow out to 650, 700 pretty quickly. And equally, in a very strong market, it could be as tight as 500. But I think in today's market, you're probably looking at high 500s, low 600s.
And then does the lack of diversity when compared to the US, does that mean that the CLO needs some additional equity capital to support the double B?
So yes, for instance, AAA, your typical subordination in the US is somewhere between 35 and 36%. The equivalent in Europe would be more like 38 to 39%. So you are going to have less leverage across your structure. If you just go down to double Bs, you will have to issue more equity in Europe. But typically what happens is they issue single Bs as well. So actually, if you look for the same size deal in Europe, you would generally have a smaller equity ticket. But because you're getting less efficient leverage, you're going to have a more expensive leverage than you would in the US.
So what are the economics then of the single B?
The single B can be volatile. So right now it's probably high 800s, low 900s DM, probably at a price of 98 or 97.
And then once you issue the double B and the single B, how much equity is left in the deal? Is it 7% or 6% or something?
So the enhancement on the junior note is 6.5%. So for say a 400 million transaction, you could do 30 million or 31 million of equity.
And then is the equity in Europe, is it typically bought by third parties like a Flatrock, or is the manager putting the CLO equity into their own funds?
So this has evolved considerably over the last 4 or 5 years, I would say. So PGIM is now one of the minority of CLO managers that is 100% third-party equity. So in our transactions, 95% is sold to third parties. I think if you look at the rest of the top 10 managers, they all have captive equity funds. So it's effectively the managers managing that money instead of each individual deal having an individual third party. If I was to talk about percentages of the market, it's not all published anywhere, but I think you're probably out of the 50 managers that are currently active, you're probably talking somewhere between 5 and 10 of them are third-party equity guys. The rest would be captive fund guys. And I would say 5-6 years ago, that was probably closer to 60-40.
So then are people investing in Euro CLO securities? I mean, these are investors that their assets are in euros as well? Or do you think people are, like myself, I'm a US dollar funder, if you will. So people give me their US dollars, they want to return in dollars. Are you seeing people like me come across the pond looking at European CLOs and just maybe taking the currency risk or trying to hedge it? Or are these more European asset managers who already fund in euros and the risk return of CLO equity or double Bs or up the stack?
See, I would say certainly on the equity tranche, if I look at our equity investors, you're pretty close to 50-50, I would say, between the US and Europe. So we do have a lot of US investors that relative value between the US and the European market at any given time. And any hedging that they're doing is happening away from the CLO. So I don't see what that looks like, but presumably they are hedging it somehow. And I think similar to the US, I mean, when you go into the debt of the structure, certainly on the AAA level, a large portion is coming out of Asia, in particular Japan, but you would have some US banks there as well.
So the AAA through maybe single A that comes out of Japan, I mean, those are banks that are buying Euro CLOs, and then they have some hedging program that converts those euros back to yen at some point.
Yes. So these are quite established buyers. They're buying big size. So I think this happens between the bank and them. So we're not party to exactly what it looks like, but that would all be 100% hedged on their side. I think it's a lot easier to hedge AAAs where you know the cash flows versus equity, which can be a lot more variable.
So then if somebody's doing relative value, let's just stay with equity for a second, amongst the two different markets, I guess it's easy to run your scenarios through Intex, and presumably a US CLO equity tranche and a European would spit out different projected IRRs. Would, in general, that potential investor, would they see the European collateral pool as a more safe and stable one?
I think that's changed over time. I would say historically, US pools were always viewed as lower risk and more diversified and better quality. especially with the LME activity we're seeing in the US, I think a lot of people are starting to question that. Additionally, I mean, certainly the course of this year, I was just at the Global ABS conference in Barcelona where we met a lot of international investors, and there's definitely a tone of people that were historically all in on US, maybe thinking that diversity away from the US is maybe the thing to do right now. So I think that historically, it's always been viewed the US is the superior market, and you don't get many European investors that don't do US, but you get a lot of US investors that don't do Europe. But I think there may be a bit of a change given the recent macro events.
So if somebody were to begin investing in European CLO securities, my understanding of the market is that it's pretty clubby, whereas in the US CLO market, it's a lot of people with sharp elbows, I think, and relationships matter, but the economics of trades is really the key driver. Is it possible? I guess people are doing it, but you see a lot of investors come over there and have success in navigating a market that's more relationship based.
I think so. And I think you probably distinguish at this point between taking majority equity and being involved in the warehouse versus when the deal is brought to market and maybe a minority is sold at that point. I think the relationship aspect in Europe is huge in terms of deciding to do a transaction together and being involved right from the warehouse stage through to the CLO. Where it gets maybe a bit more transactional is if you want to sell some equity at the time of your CLO pricing. I think runs will be sent out to everyone and everyone will put their bids in. That will be a lot more transactional. So I haven't been involved in the US market to know if that follows the same dynamics, but I think in Europe, and I think this is what most people do, is you go to some of these conferences and all of the managers are there. And if you sit down with a manager and you express an interest in getting involved in equity, I think most of them will go out of their way to help educate and get anyone up the curve and explain to them how things work. And you probably do that with multiple managers, so you don't have a single guy. But I don't think it's a difficult club to penetrate, especially if most European managers will have a US affiliate. And if there's a relationship existing on that side of things, it obviously makes things a lot more easy as well. But I think it's a fairly open community. And I think the problem, certainly from an equity perspective, is the amount of captive funds that are in the European market means that with those funds, minority equity is the only piece that's sold, and that is usually sold in the transactional way on the day of pricing, whereas the 95% third-party guys is still very relationship-based.
In the US, we have around 100 active managers, and I think if you're willing to invest in one of their warehouses, be that equity, and participate in the takeout, I think it's probably not too hard to find many who will take you up on that.
I would say that historically was the case in Europe. You had a big pipeline and the successful managers generally had, and this is in European perspective, quite a lot of warehouses, but you might have 3 or 4 open at a given time, which is probably about a year's worth of issuance. So getting in the pipeline was generally a year in advance. I would say with the amount of new entrants to the European market, as well as the amount of secondary or in minority equity that's available at primary from the retention fund type vehicles, we've seen that lower down a bit because I think there's more supply than there used to be. And I don't think the equity base has materially increased. So I think it used to be, as you describe in Europe as well, probably less so in the last couple of years.
So one of the big changes to the US market over the last 2 or 3 years is just the rise of ETFs, the exchange traded funds, where lots of retail investors now own CLO securities. Is that something that is beginning in Europe?
I think it's beginning. So I think we've got 3 or 4 that have launched in the last year or so, none of them to the scale of what we've seen in the US yet. I'm not an expert on the regulations behind it, but my high level understanding is the retail investor is a lot harder to access in Europe, whereas in the US, you can go onto your personal trading app and access a bunch of these things. In Europe, to get it to show up on your list, you've got to qualify as a certain type of investor, which means going out of your way to answer some questions and get signed off. So I think the barriers to investing are a bit higher in Europe, but I think if you look at generally how things go, if it works in the US with a lag effect, it's likely to come to Europe as well. We're just a little bit behind you guys.
Are there any other big differences between European and US CLOs that we haven't covered?
One thing that is present in European CLOs that is probably viewed as a negative in US CLOs is maybe the ESG elements. So In European CLOs, it's become fairly standard to have an exclusion list in your CLOs. And you've got a lot of European managers. And a lot of this is coming from the European investor base that is very ESG focused.
ESG is the inclusion of environmental, social, and governance factors in investment decisions.
And a lot of managers are doing a lot of ESG work on their non-CLO funds. So you'll see a lot of managers, including us, will put additional ESG information in their reports, as well as having quite a conclusive ESG exclusion list.
Okay, so ESG exclusion so we're talking about dirty coal, and what other industries can be excluded or would be commonly excluded?
You can have stuff like gambling, tobacco, alcohol, anything. This can differ a lot between transactions, but I think in a typical European transaction, you probably have somewhere between 20 and 30 exclusions. And it would be a lot of the energy ones, a lot to do with weapons and ammunition, anything that someone somewhere has thought that could be viewed as an ESG point. So you probably have, I'm not an expert on US documentation. I think there are some exclusions that go into US documents, but I think they existed for a long time. I would say that it's significantly more comprehensive in European transactions.
In the US, I hear very little talk of ESG. And I think it's partially because of the difficulty in quantifying the criteria. Any other key differences, Brian?
Maybe the risk retention as well. So obviously, historically, this was present in the US as well, but I don't know how long ago, 7, 8 years ago, it was repealed in the US. So it's not a thing anymore, unless you have a manager that wants to do it for accessing European investors. But obviously, every deal in Europe is risk retention compliant, which is a 5% co-investment in the vehicle by the sponsor or the originator, which in the vast majority of circumstances is the manager or a manager entity. Or you can have, some people use a third-party originator where I think it's a skin in the game thing. So to qualify, you basically have to take underlying risk on the assets that are going into the CLO. So I think depending on who you talk to, I think a lot of European managers would say it's not needed, but from an investor perspective, I think it's probably only a good thing if the manager is required to put skin in the game as well. You have two ways of solving for this, which is either a vertical retention where you take 5% of every tranche, or you take it horizontal, which is you take 5% of the transaction size in the equity tranche. So I think historically, we call them captive funds, but most of them in Europe started out as retention funds, where managers would go out and raise enough capital to do the next 7, 8 deals and be the retention provider. I think that's evolved a little bit in Europe, that people are doing it over and above just for retention purposes. But I think that's a key difference. And again, this is maybe a European perspective, but I think when the manager has a requirement to put 5% of the capital into the structure, it does maybe raise the barrier of entry in Europe from a manager perspective. And also, I guess over time, this maybe compresses, but I think historically European management fees have been higher than the US. And I think generally what we've always said is that capital requirement is potentially part of that as well, that in order for it to be economic for the manager to put 5% into every transaction, it does have that impact in terms of the hurdle rate on the fee side. So I think that the retention is quite a big difference, and it probably has a couple of knock-on effects.
So European risk retention is something I come across quite a bit, just because in our US CLOs, there is not the requirement, at least for broadly syndicated, there is not the requirement for the manager to own the 5% vertical strip or half the equity roughly. But when you're selling CLO securities, there's a lot of investors in Europe who, if you want to market the CLOs AAA or whatever to them, the CLO needs to be risk retention compliant. So even if you're not bound to those rules in the US, the manager or some affiliated vehicle needs to buy the CLO securities so that you can gather up European investors if you want to go that route.
Yeah, I think you'll know better than me, but anecdotally, I think someone told me it's somewhere around the 1 in 10 transactions is risk retention compliant in the US. So yeah, obviously that's 100% in Europe.
I do a lot of middle market CLOs, and those are actually still on the European standard. So there's still the risk retention capital is required there here in the US.
As an investor, do you see that as a positive, negative, or neutral?
If a manager, let's say they own a 5% vertical strip, do I really care? Not that much. Imagine, so 65% of what they are committing to is AAA. They're comfortable owning the AAA in their own deal. It's not a huge vote of confidence for me. And then 5% of the equity and the other more junior securities, I think it's helpful. I mean, I would take it if offered. I think for a lot of CLO management platforms, they do a lot of deals, and to put up 5% of the capital in each one, I think that's really quite a burden on their platform. I think probably the ultimate alignment is we've been in some deals where the CLO equity is also going into the personal PAs, the personal accounts of the CLO managers, so directly in, and that is, I think, a very strong alignment. Let's say a manager hasn't invested in any of the CLO securities that I'm in. So what's the alignment? Well, I think it's still pretty strong because one, there's an incentive fee that could be material for the manager if they really perform. Two, CLO management is a competitive business. And if a CLO manager doesn't do a great job with the assets, then they're going to struggle to find new investors. So I don't think there's a risk that there's some orphan CLO at the manager where they didn't invest in it and don't prioritize it like the others. I just don't see that as a risk.
No, I think a lot of CLO managers would agree with you on that one, certainly from the capital requirements of building a large platform point of view.
How easy is it to get allocations of new loans in Europe?
Relationships still play a key part. I mean, a typical loan that comes to market that's well liked by CLOs can be quite easily 6 to 7 times oversubscribed. So the relationships do become a big part of it. And obviously, yeah, the bigger you are, the more important you are to the bank. Typically, that would lead to better allocations. So it's, yeah, you could say that maybe the managers that don't have those relationships are potentially taking all the stuff that the other guys don't want. But I think even as one of the biggest managers, while we might get an oversized allocation, we still, on a deal like that, it's not like you're getting anywhere close to 100% fill. So if you look at the amount of managers across the market and the amount of assets in their deals, I think it's probably gotten a little better than it used to be in terms of new managers getting allocation. And all the different term loans, my time from banking, all I know is A and B, where A was amortizing and B was a bullet. And that's actually one difference, I think, actually with US and Europe that I didn't cover is the US deals will generally have a small amortization in them, the underlying loans, whereas Europe is very much bullet.
So you don't have the 1% amortization, it's just zero amortization and
Exactly.
you're due the principal at the end.
Speaking to our US guys, obviously when a CLO goes post-reinvestment period, it becomes a bit more restrictive on what you can reinvest. And the documents are very prescriptive in terms of the source of the funds and what you can do with that. So I know having that amortization coming in on 250 loans makes things significantly more complicated in the US to reinvest post-reinvestment period. So that's something that we've become more aware of as we have our monthly meetings and we talk about what's the workload in each of the teams. And they're spending a lot of time on figuring out reinvestment. And we're going, what are they doing? Until we dug in to find out what the reason was. So that's an interesting query. I don't know why that is the case, but yeah, Europe bullet loans don't have any amortization.
One thing you mentioned was that the management fees are higher in Europe. In the US, for broadly syndicated, I would say 40 basis points is probably a fair fee. And then the incentive is 20 over 12. The 12 has to be earned in cash. So it takes a while for that to be paid to the manager. Obviously, they have to earn it. What's the average fee across the pond?
I would say up until maybe the last couple of years, if I look back on ours, the incentive would be the same, but the headline number would be 50 instead of 40. I would say in the last couple of years, it's maybe begun to compress a little bit. So maybe into the mid 40s, but long-term average has always been higher than the US. And I think obviously we've got quite a big manager in both markets, so we can see that over time. But I don't know if the US is compressing in the same way that Europe is right now. But up until 2 years ago, we didn't really have any struggles getting 50 basis points on every deal. I would say that's maybe more of a hot topic at the moment than it historically has been.
Great. Well, why don't we leave it at that? Brian, thanks so much for coming on the podcast. Really enjoyed our conversation.
Thank you for inviting me. I had a lot of fun.
The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. This podcast is not directed at any investment or potential investors in any Flatrock Global Fund. Definition section. Secured overnight financing rate. SOFR is a broad measure of the cost of borrowing cash overnight, collateralized by Treasury securities. The global financial crisis, GFC, was a period of extreme stress in the global financial markets and banking systems between mid-2007 and early 2009. Credit ratings are opinions about credit risk for long-term issues or instruments. The ratings lie in a spectrum ranging from the highest credit quality on one end to default or junk on the other. A AAA is the highest credit quality, a C or a D, depending on the agency. The rating is the lowest or junk quality. Leveraged loans are corporate loans to companies that are not rated investment grade. Broadly syndicated loans are underwritten by banks, rated by nationally recognized statistical ratings organizations, and often traded among market participants. Middle market loans are usually underwritten by several lenders, with the intention of holding the instrument through its maturity. Spread is the percentage difference in current yields of various classes of fixed income securities versus treasury bonds, or another benchmark bond measure. A reset is a refinancing and extension of a CLO investment period. EBITDA is earnings before interest, taxes, depreciation, and amortization. An add-back would attempt to adjust EBITDA for non-recurring items. LIBOR, the London Interbank Offer Rate, was replaced by SOFR on June 30, 2024. Delever means reducing the amount of debt financing. High-yield bonds are corporate borrowings rated below investment grade that are usually fixed rate and unsecured. Default refers to missing a contractual interest or principal payment. Debt has contractual interest, principal, and interest payments, whereas equity represents ownership in a company. Senior secured corporate loans are borrowings from a company that are backed by collateral. Junior debt ranks behind senior secured debt in its payment priority. Collateral pool refers to the sum of collateral pledged to a lender to support its repayment. A non-call period refers to the time in which a debt instrument cannot be optionally repaid. A floating rate investment has an interest rate that varies with the underlying floating rate index. RMBS are residential mortgage-backed securities. Loan-to-value is a ratio that compares the loan amount to the enterprise value of a company. GLG is a firm that sets up calls between investors and industry experts. A risk retention fund is a third-party fund raised by CLO managers to comply with the CLO risk retention rules. The US CLO risk retention rule was introduced in 2014 under the Dodd-Frank Wall Street Reform and Consumer Protection Act, requiring CLO managers to retain not less than 5% of the credit risk associated with each of their CLOs. In 2018, the U.S. risk retention requirement reversed for BSL CLO managers after being successfully challenged in court. LME stands for Liability Management Exercises, which are strategies often used by sponsors or select lenders to restructure debt obligations of distressed companies in order to avoid traditional default proceedings. FlatRock may invest in CLOs managed by podcast guests. However, the views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates. Any return projections discussed by podcast guests do not reflect FlatRock's views or expectations. This is not a recommendation for any action, and all listeners should consider these projections as hypothetical and subject to significant risks. References to interest rate moves are based on Bloomberg data. Any mentions of specific companies are for reference purposes only and are not meant to describe the investment merits of, or potential, or actual portfolio changes related to securities of those companies unless otherwise noted. All discussions are based on U.S. markets and U.S. monetary and fiscal policies. Market forecasts and projections are based on current market conditions and are subject to change without notice. Projections should not be considered a guarantee. The views and opinions expressed by the FlatRock Global speaker are those of the speaker as of the date of the broadcast, and do not necessarily represent the view of the firm as a whole. Any such views are subject to change at any time based upon market or other conditions, and FlatRock Global disclaims any responsibility to update such views. This material is not intended to be relied upon as a forecast, research, or investment advice. It is not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. Neither FlatRock Global nor the FlatRock Global speaker can be responsible for any direct or incidental loss incurred by applying any of the information offered. None of the information provided should be regarded as a suggestion to engage in or refrain from any investment-related course of action, as neither FlatRock Global nor its affiliates are undertaking to provide impartial investment advice. Act as an impartial advisor or give advice in a fiduciary capacity. Additional information about this podcast, along with an edited transcript, may be obtained by visiting flatrockglobal.com.